touch base on the Middle East tensions, which are now diminishing and creating a more risk-on scenario in our markets at the moment, which is going to be great for some of the particular trade ideas that I've pulled out for this week's report. So again, good morning everybody. Hope you're doing well. I know most of you will be catching up on this in a couple of hours time. I will just take the time here just to apologize about the fact that I'm coming on at short notice in the morning and not this afternoon. As I said, it is 26 degrees outside at the moment at 9:30 in the morning. We are expecting what's classified as a heat dome as far as the Met Office is concerned, rising over London today, and it's seriously supposed to get crazy. I think Kent's supposed to be 37 today, with North London, where I'm based currently, at about 34, which means in the office it will be a good 3 to 4 degrees higher than that, and peak is at 1:30, which is when I would usually do the afternoon session. So there's no way I'm going to stick around in the office for that, and I'm going to be sat in front of the fans outside the back of the house or whatever this afternoon, working off the laptop, which frankly just isn't good enough for doing the live events. So that's enough of my excuses. So we have got a surprising week probably to some of you who are newer members. We actually have the non-farm payroll this week, as is the normal process, but instead of the Friday, it's on the Thursday. There are four weeks in the year where the NFP is on a Thursday instead of a Friday, or the second Friday of the month instead of the first one. And this is one of those peculiarities. So the NFP, as I said, will be on the Thursday. There will be the big NFP live show. It will be, live trading. We are going to be attacking that one head on. So look forward to that. I'm going to send out the event link to that in the next couple of hours after the session is done. What we're going to do today is relatively the same as the afternoon, probably be a little bit of a shorter session just because we won't be running through the US market setups in real time. I'll be releasing the written and articulated reports for those this afternoon for the trading session, but starting the day off with the report breakdown. So I'll be going through the report. We'll be having a look at that one, dissecting it if you like, and then after that we'll be heading over to the charts, have a bit of a scan around the markets, see what's occurring, touch base on the Middle East tensions, which are now diminishing and creating a more risk-on scenario in our markets at the moment, which is going to be great for some of the particular trade ideas that I've pulled out for this week's report. So we'll get cracking on there. I just need to find out. There it is. Okay, cool. Okay, so last week, which was our last trading week of Q2 2025. Obviously, we're on the 30th of June today, which is the last day of Q2. But of course, last week was our full last trading week, and it turned in to be a beast, frankly, pulling in 5.12% net profits last week out of the markets. Most of the profits coming from the indices at 66.67%, as you can see here. And the Forex indicating 29.17%, with commodities only breaching the 4% by a smidge. So commodities barely accounted for any of last week's gains whatsoever, or exposure, shall I say. And the indices really did take the forefront of those. We did get a couple of nice wins on the Friday afternoon. They weren't necessarily too big in terms of their risk rewards. I think one even pulled a 0.49 net result, whereas the other one was a 0.5%. So they weren't huge. They weren't huge wins, but it was nice to finish the week with a couple of wins there as well, because it was a pretty turbulent week still. We did see a lot of inconsistency, but I think this makes this figure even more impressive. I don't actually have my NT5 open. hang on a minute. Okay, so yeah, I mean, it was really, really mixed. Yeah, it was really mixed. I'll take a screenshot of the history so you guys can see. But yeah, so that was last week's trading report. So it was a really busy week in terms of positions taken. We did get a lot done, but as you will see, there was some really, really choppy times with a lot of sort of inconsistency, I would say, in win-loss ratio. In fact, the win-loss ratio actually took a hit, and I think I mentioned that on the report itself, on the little entry blurb there somewhere. Let's have a flashback. And so strong last week to the financial quarter, slight increase in trading volume, certainly pulled our weight in the risk-reward yields, albeit taking a step back in the overall win-loss ratio. So I don't include the win-loss ratio on here because, frankly, it doesn't mean anything, right? It's just bragging rights at the end of the day. But the win-loss ratio was at 55.88% on the Monday, and we finished at a 55.6%. Now, you know, it doesn't sound like much, but of course, that is a super large amount of data that it's working with. So to take an almost 0.3% reduction in win-loss ratio is actually quite a jump down in just one single trading week. Usually things would be quite a bit more, you know, they'd be a fair bit more slower than that to deteriorate at this stage of the portfolio's growth now because of the amount of positions that have been taken over the course of the last three years, whatever. So yes, it was pretty up and down. The day-to-day gains, though, as you will see, we didn't actually suffer a single losing day, which I find just ridiculous when going back over the trading performance and when I was going through my reflection period on Friday. Yes, okay, Tuesday, Wednesday were basically dud days. We did 0.1% on both Tuesday and Wednesday after the losses were taken off of the wins as well. So they were ultimately break-even days. But the Monday, Thursday, were fantastic. Friday coming in at just under that 1% level at 0.9% or something like that. With the Monday 1.73 and the Tuesday was 2.14. So yeah, not too bad at all. And just to amass the 5.12% at the end of last week was really, really bloody good, I think, if I don't say so myself, I suppose. Looking down then at the portfolio metrics, we're averaging around a 3% weekly gain due to last week. That was thanks to that. We were at a 2.8 before that, 2.9 I think. So we brought that up to 3% weekly when broken down. Monthly return 13.2% on average. Yearly at 79% total so far, with an average risk reward over the total year at 2.7%. So that's some really, really positive, healthy data. And I think we will certainly be smashing the 100% growth in a year at this stage, which would be fantastic. I did manage to find the data for April as well as May, so that was really good. So as you can see here, we've actually had a bit of an upward trend in trading volume. I don't know if there's anything in that necessarily, probably not, but it has been. So as time's gone on, we are taking more and more positions. The win-loss ratio is declining, but it should, because of the law of large numbers, as we continue on, it should get more closer to 50% down the line. So I imagine in maybe 2027, 2028, we will be very, very close to that 50-50 win-loss ratio and sort of just remaining hovering around there as all strategies, you know, probably would do, unless you start branching out into the sort of full-fledged hedge fund methodology, which we incorporate, but we don't actively execute on a day-to-day basis. As a CFD trader, it can be a little bit difficult at times, I suppose, to employ that kind of trading strategy, especially when you're focusing on non-equity CFDs as well, you know, commodities, FX instruments, indices, and stuff like that. And so looking at the cumulative return so far, obviously excluding withdrawals, 743.11%. Again, really, really happy with that. Nothing more to be said. Last week was a mind-blowing week for the S&P 500 and the rest of the US indices. They did really, really well. It is also safe to say that the EU 50 and the DAX both did extremely well as well, but I use the UK FTSE as the benchmark because it is a tough one, it is a European one, and it also has global reach. So it's a good one, and that only gained 1.48% from low to high. S&P 500 though was absolutely staggering, and it also translates really nicely into what we had managed to achieve last week as well. It was a really big explosive week, but it was in broad market terms as well. So it kind of, I suppose, what's the term I'm looking for? It kind of balances it out a little bit. It's not so much of a wild card to see that 5% return when the broad markets actually did very well themselves. So as we go down into market trends and opportunities then, like I say, we've got a really nice strong basket this week of market opportunities. UK Brent is ridiculous with the amount of supply that we saw, the increase in supply. Now, obviously, we had the really nice big bullish candlestick, and this came as a direct result of the Middle Eastern tensions. Frankly, with the Strait, their logistical standpoint as well, is very, very, very good for buying energy markets in amongst all of that chaos, because of the demand vacuum that we were part of, that we witnessed. Of course, though, when things were diminished, that all went away very quickly, and in one single day we just absolutely crushed it, and now we're actually trading below big liquidity. So this week with UK Brent, I am looking at a split decision, but the problem is I won't actually be looking to actively trade UK Brent long until we're trading above the break of structural element here. So even though I've indicated that we might end up at around that sort of, let me zoom in here for a moment, that $70 a barrel point, it's not an exact trading opportunity because of where we are, and I'm not entirely sure I want to get stuck into trading oil longs through the liquidity point like that. Sorry guys. So through the liquidity point like that. Now, in terms of the short, the breaker structure point is actually very clear here. So from that high to this low for the retest, across the bottom of all of these lows where we are and where we have been consolidating at the moment, I think if we can get a nice strong breaker structure below there on the daily time frame, a drop down to around 63.50, 63.70 bucks a barrel is probably going to be on the cards, which makes that short quite a nice opportunity. But as I said, we'll have to come back to the long. Now, in terms of the US 30 DJI this week, I think we've got all-time high takeouts on the cards. That's my view, and the official view of the company. With the Middle Eastern tensions tapering off, we believe ultimately, exactly as I've said here, that stocks will continue inflating, and the US 30 Dow Jones is at this time staggered behind the NAS 100 and the S&P. So I think there's certainly a little bit of room to maneuver there, and to see that sort of maybe 44.80, 44.90 level up at the liquidity there, around that ATH zone is probably going to be on the cards. However, if we do reject this level and the retest fails, we are not without some money-making opportunities here because of the point in which we are breaking through. The margin to trade is ultimately from here to here. This area in the middle is the median, so we can take longs between the upper half, or we can take shorts in the lower half. The margin is so wide here, because we're discussing this on a daily chart, that the 15-minute time frame is going to be relatively unaffected by, by the big daily levels. The trading margin there is absolutely more than sufficient for us to work with. Heading over to the CAD Swiss then this week. CAD Swiss looking superb, and I believe it is a very nice risk play as well. I've mentioned my thoughts down here. I'm not going to read it out word for word, but you can go through that yourselves when you download the report. Ultimately though, guys, really nice big cash rich inflection point down at 58.50. Risk on coming back into the markets here as we have tensions easing between the Middle East and the US, and the Middle East and themselves. Also, aside from that, we have the trade as well, which is, trade talks are sort of starting to flow a little bit smoother at the moment. Things just seem a little bit more easy. And after the period of time that we've had, which has been pure carnage, I'm not surprised that investor sentiment is switching over to risk on mode. And in doing so, we'll see a reduction in the Swiss, we'll see a rally back in the commodity currencies, CAD, NZD and Australian dollar, historically speaking, and I think this makes up for a really nice buy, fundamentally, of course, and technically speaking, which is our sweet spot here at the UTC. So that's exactly what we want to see there for the CAD Swiss. And then finally going down to gold. Now, gold doesn't actually look that great this week, but I wanted to get a metal in there. I didn't want to do silver, and so here we go. So gold at the moment is in a very precarious position. The long opportunity will only come into fruition at around 33.50. Bearing in mind we're only trading at 32.91 at the moment, so it has to jump quite a ways before we're going to even begin to be interested in it. The short does hold the power, and from a fundamental point of view, I believe that that is the winning idea as well. With tensions easing, with trade easing, we have more risk being taken on by investors, which means safe haven capital flow will flee from gold back into the United States dollar, forcing the gold value down. So fundamentally, again, it makes sense. From a technical perspective, we're certainly seeing the right level of breaker structure access points around here. We've got the first one up there. We've got the second one down here. Really nice couple of trading opportunities, which I think, you know, could be well on the cards for us this week. And the kind of margins that I like to work with as well. I think if I took a long in gold, I'd be probably a bit concerned about its sort of time completion by Friday. As we've seen recently, it's been very, very choppy waters. And that's that for the market opportunities. Now, in terms of market challenges this week, US jobs job openings, US unemployment, and US non-farm payrolls. Now, if we go over to the econ, which we will do in a moment, you'll see that there is next to nothing on Friday. There's nothing today. And Tuesday, the only thing registering is a 3 out of 10 on the US jobs. And then it's all Thursday. So even though we've got some major fundamental events taking place, they are far and few between, so we don't really have too much going on this week in a consistent sense. So we will have to be sort of making the most of it, let's say. Heading back down now to commercial longs versus shorts. No notable call-outs aside for one particular thing. US 30 Dow. 60.12% of commercial orders are long currently in the US 30 Dow Jones. Now, if that's not a reason to buy the damn thing, then I don't know what is. Obviously, you cannot just take a long based on this blindly, but it is a fantastic confluence indicator to where, as the YouTube gurus nowadays called, smart money is trading, and that right there is good proof of that. We do have a massive imbalance here of commercial positioning, versus their shorts. So I think that's a really good indicator to suggest where we could be going over the course of the next 5 trading days, let's say. CAD Swiss is probably worth a notable call out, 53%. It's just 1% over that sort of freeable margin there. I mean, look, in conjunction with the fact of where we're trading from and what I've outlined with in terms of the risk on sentiment, it's a great confluence, but it's not quite the notable call out of the US 30 Dow Jones at the moment. VIX volatility is down though, and the volatility index currently trading, I think it's 17. It's ridiculously low. So market volatility is pretty depleted at the moment. We are on the last day of Q2. Even the first week of Q3 is all going to be about commercial rebalancing. Lots of money being taken out, lots of money being placed back in, lots of orders being triggered, pending orders, limit orders, and so on and so forth. We have to take all of this into consideration because it will create, again, what we've seen recently, quite turbulent, inconsistent market mixed volatility. Right, heading down then into the economic and order book impact report. Again, we have JOLTS, US unemployment rate, and the US non-farm payrolls. Frankly, guys, it is pretty much the same as market challenges because they are the only things taking place this week, and it's all US dollar related, which impacts obviously gold, US 30 DJI, and to a certain extent UK Brent as well. In terms of what we're seeing in the numbers, it's 9 out of 10 from the US non-farm payrolls. I think that's probably going to be, honestly, a bit incorrect. US non-farm payroll this week is at 110k, I believe, under a 130k previous figure, which means the data continues to be very stable. I think the model takes, an average of every. Well, I know for a fact it takes an average of everything, but I think it's thinking on the averages more so than anything else than the individual data here. So it's probably taking an average of the last 10 NFPs and thinking, well, it could be a bit of a major volatility strike. I still think we're going to get a decent breakout on the stocks. In terms of gold, I think it's going to be a bit of a non-impact event, honestly. I think the DXY as well, I think you'd be lucky to see much of anything happening in the DXY, but we'll be monitoring it in real time and taking trading opportunities as and when they become available regardless. So stay tuned for that one. Heading back down then to the equities and the rest of the commercial data here. So this is total market liquidity. At the moment, there are no notable call-outs whatsoever. Everything is being rebalanced. We did have some notable call-outs on last week's market report. Everything is coming back down now. It's all being rebalanced. So I'm not surprised whatsoever to see this kind of balance out there in the markets at the moment. And then equities in focus this week. Got some really interesting choices for you. ASML Holdings, very interesting one. Highly recommend going to check it out if you are interested in the equity space. So please go and do so as soon as possible. And then our institutional buying interest by sector, which has technology at the back end, interestingly enough. Financials at third place, industrial at second, and energy keeps the top spot at a full 10 out of 10. And that is the market report there, team.